Real estate is a powerful vehicle to build wealth. Yet many people are intimidated by the thought of owning properties. They think it's a rich man's game. But the truth is, you don't need to be rich to start. You need capital. Capital is the fuel that drives real estate investments. It's the money you use to buy, renovate, and manage properties. Without capital, you can't play the game. Think of it like this. Capital is your army of dollar bills. You send them out to conquer territories or properties and bring back more troops, which is cash flow. So, how do you raise capital? Let's explore. Before you even think about buying an apartment building, you need to determine how much capital you need. This is like a general surveying the battlefield before launching an attack. First, determine the purchase price of the property. This is the biggest chunk of your capital requirement. Next, factor in closing costs such as legal fees, inspection fees, and loan origination fees. These costs can add up quickly. Don't forget about renovation costs. Will you need to upgrade kitchens, bathrooms, or common areas? These improvements can increase your rental income but require upfront capital. Finally, always include operating reserves for unexpected expenses like repairs or vacancies. There are two primary sources of capital: debt and equity. It's not about choosing one or the other, but rather finding the right mix for your situation. Debt financing is like borrowing a friend's car. You get to use it for a while, but you have to pay it back with interest. Banks are the most common source of debt financing for real estate. Equity, on the other hand, is your own skin in the game. It's the cash you invest directly. You can raise equity from your savings, partnerships, or private investors. Each has pros and cons. Debt allows you to leverage, controlling more assets with less of your own money. Equity doesn't have monthly payments and gives you more control. The ideal capital structure, or the mix of debt and equity, depends on your risk tolerance, financial situation, and the specific property. A conservative approach might be a 70% loan-to-value ratio, meaning 70% debt and 30% equity. This minimizes risk but also reduces potential returns. A more aggressive approach might involve 80% or even 90% financing, maximizing leverage but increasing risk. Imagine you want to buy a $1 million apartment building. With a 70% loan, you'd need $300,000 in equity and $700,000 in debt. Finding the right funding formula is crucial for long-term success in real estate.